So I will only send since this is my first live, I will only send analysis. We only analyze gold together. This is the gold market. So when you come to the chart like this, there's what we call the top down analysis. Top down analysis is the analyzing of market charts from higher time frame to lower time frame. So this is the monthly time frame. This is where we are now. So this is the monthly time frame. So you can see where in the monthly time frame we are bullish. We are bullish here. So let's drop down to the weekly. Weekly time frame. We have this long-term high here. Long-term high. Yeah. Most times I just see it's okay. Just try to abbreviate it. So that's long-term high, and if you look at this market in the weekly time frame, you can see this market has been going bullish. Market went bullish from here, displacement, then it retraced, forming what? A higher low, then it pushes to the upside again, forming a higher high, then it dropped down, higher low. This is a swing low. This low right here that I'm pointing at, this low is a swing low. Why is it a swing low? Because it has what? A higher candle to the left and a higher candle to the right. That's why it's a swing low. So price form what? Another higher low. Then this is just what simple technical analysis I'm doing with you guys here. I'm not going to the advanced level. This is just the basics. So price form again, higher high. As usual, we expect what? A higher low. This is what we see here. So notice how price pushed to the upside. Normally, if you look at previous price action, we are supposed to what? Expect a higher high. We are supposed to expect a higher high. Let me remove this. We are supposed to expect a higher high, but the market failed to do that. Market failed to form what? A higher high. So automatically this becomes what? Our long-term high, as market failed to take this high. Instead, the market formed what? Market formed what? A lower high. I'll write this one out for you. So a lower high. So market formed the lower high, that is, it failed to form higher high. Then as the market start dropping, we expect what? The market to what? To form what? A lower low, which means this higher low here, this higher low here, this is just simple technical analysis. The market failed to form what? A higher high, forming what? A lower high. Let me try and make it simplistic. So anyway, it's CHH, just know it's higher high. So fail to form a higher high. This is a higher low. So automatically this level, excuse me, let me okay, I'm back. Sorry for that. So the market it failed to form a higher high, forming a lower high, yeah? So the market begins to drop and drops to a higher low, which is this level here, a higher low, this one I outlined here. So the market dropped and it goes below this higher low. So if you notice we've been bullish ever since. So, but all of a sudden the market just begins to drop. Because if you look at this price action here, if you look at how the price has been dropping, forming higher lows. If you notice this one here, this current one here, if you see that this one is very significant compared to the previous drop market has been dropping, compared to the previous higher lows market has been forming. If you notice this one here, this one is very significant. So if you look at this higher lows, we have to define our range. Let's define our range, our trading range. So this is the first range, first low. Okay, let me use a trend line for you guys so it will be easier. Higher low here, higher high. Then the market from the higher low, then higher high. So this is a range. So the market from the higher low, higher high. Let me put it here, higher high. So so from here the market it formed the higher low, but it failed to break this range here. So this we are still in this trading range. If you remove this, just ignore this bearish candle now. Ignore this. If you look at the market from this non-shaded area to the left hand side, you'll notice that we are still in this trading range here, from this low to this high, from this higher low to this higher high. We are still in this trading range. So the market dropped, retraced. So expect the market to form higher highs. Then it failed to form higher highs, forming a lower high. Then it begins to drop. It begins to drop, and it breaks the range. So what will you call this now? From the perspective, we will say this is this is a shift in market structure. We are not looking at the fundamental yet because we don't know if this is just a stop run. You understand? So if you are looking at it from a fundamental perspective now, let's say the war between US and Iran is going to continue, and it's going to be longer for more, like it's going to go on for months. You understand? Because that's what pushing pressure on the gold. That's why the gold is dropping. So if we see that okay, the war is going to continue, like it's going to continue longer for more, like it's going to continue for months, then we can say okay, since there's no hope that this war is going to stop, or there's no hope for de-escalation, then we can say this is a break in market structure. You understand? A break in market structure is just like a change of directional bias in a high time frame. That's a break in market structure. So the market has been bullish, then as soon as it breaks the range, that's a break in market structure. Or as soon as it trades below a trading range, that is a defined trading range, that is a what? A break in market structure. So for now, what we just have in mind is okay, this is a break in market structure from a technical perspective. That's if we are not looking at the fundamental aspect of things now. If we are not looking from that point of view. If we are looking at it technically, we can say this is a break in market structure. So I'll outline it. Let me just BOS, break of structure. So I want to remove these arrows now, so we can okay. Okay, so let me check. Okay. So this is our range from this higher low, this higher high. Then the market what? It breaks that range, which is going below this higher low, which is what? A break of structure or a break in market structure. So what are we going to expect? After the break of structure, normally we expect what? The market to what? To retrace. That is because of market efficiency. If you have studied auction theory, that is normal for the market. After a break in market structure, there's always a retracement. Or most of the time, I would say 90% of the time, there's always a retracement, especially in higher time frame, and especially in market that has been bullish for long, market that has been bearish for long. After the market breaks that structure, there's always a retracement. So what we are expecting now, we are expecting what? A retracement. Let me remove this shaded okay. Okay, so this drop give us what? Our break of structure. So automatically this becomes what? A long-term high, and also you can also call it intermediate term high. But since the market has been going on for long and it's it's an all-time high, we'll just call it long-term high, because it's an all-time high. Because if the market breaks here and the market begins to drop, the reason why I'm calling it long-term high is because it will take a long time for the market to reach for this level. It will take a long time for the market to reach for that level. You understand? Okay. So let's go. I think we are going to over to a lower time frame now. So right now, after the market breaks this structure, our new trading range will be this long-term high to this lower low that break the structure here. So this long-term high to this lower low is our new trading range. You understand? This long-term high to this lower low is our new trading range. So if we want to define a setup in this weekly time frame, we are going to be using this range, this long-term high to this lower low here. Let me outline it. Okay. So this lower low here. So we'll go over to the daily time frame now. So this is our trading range. Let me remove this. From this long-term high to this lower low. This was the higher low here that the market broke. You understand? So now what we are expecting now, we are expecting the market to form another lower high, which means we are expecting the market to push to the upside to form a lower high. Now this is where it becomes very technical. This market, it can push all the way to this higher, Why? Because even if this market pushes all the way to this high, we can say, okay, this, even if it breaks this high, it is still in our trading range, which is from this high, this long-term high, to this lower low, but that it will take a lot of time. In a sense, yes, it will take 3 weeks at least, almost a month. It will say the market should the market should continue going up and take this high. But for now, since we are not investing like in the long term, what we do is we focus on what the market is doing now, which is retracement. There's what we call the void of liquidity. There's what we call the sell side imbalance, buy side inefficiency, which is what I will show you now. This is what a sell side imbalance, buy side inefficiency. Let me try to. Yeah. So in concept of retracement, we want to see market retrace towards to fill pockets of price action, which is sell side imbalance, buy side inefficiency, or buy side imbalance, sell side inefficiency, or liquidity voids, liquidity boosts, or volume imbalances. This is an example of a volume imbalance. So when you see this kind of sharp run in price to the downside or to the upside, no matter how long it takes, the market will at a certain point in time retrace to fill those pockets of price action. Now you may ask why does this happen? The reason is because the market has to be efficient. If the market is not efficient, the market will collapse. You can't just see the market, you can't just see the market just dropping for a long time. That's why if you go to a higher time frame, let me go to the monthly. This buy side imbalance, sell side inefficiency, the market will surely reach for this level at a certain point in time. It will reach for this level here. That's one thing about the market. So the market, it has to be efficient. So there needs to be a balance between the buyers and the sellers. That is one thing about the market. From there we'll talk about auction theory. So there needs to be balance between the buyers and the sellers. You understand? So right now we are expecting the market to what form a lower high. So that's to tell you that what we are bullish in the short term in the gold market. So the reason why I don't expect the market to what to start dropping from here, and I'm not completely sure, or I'm not sure that it has what retraced enough, is because the market has to retrace towards a premium. So when it comes to market efficiency and market making, the market makers, the banks, the banks, they usually sell at premium level and buy at a discount. That's what they usually do. They sell at a premium, they buy at a discount. So if you look at this trading range, this is my equilibrium level. This equilibrium level means what? Price is what at a fair value. If the price what gets to this level, this equilibrium, it's at a fair value. Then if price is below this equilibrium, that's to tell you that the price is still considered what? Is still considered cheap. So if they want to sell, they have to sell what? Expensive. That's what they do, because they are the owners of the market, you understand? So when they want to sell, they sell. It's just like somebody doing mini importation, and when you import your goods, you can't sell it the same price. You can't sell it the same price you buy it from China. So you have to sell it at a higher price. So that is what they do in the market. Just that is the gold. They are selling the gold at a higher price. So replace your gadget or your phone, your gadget or your laptops or your clothes that you are selling from your mini importation or your business. Just replace it with metals like gold, the gold commodity. So if you replace it with that, you sell at a higher price, because you are the market maker, you are the one selling, you are the one offering the price. So when you want to sell, you sell at a higher price, and when you want to buy, you usually buy cheap. That's basically what they are doing here. So that's basically what the market is doing here. Don't try to confuse yourself. You understand? So one thing you should have in mind that institutions mostly sell from a premium, and they mostly buy it from a discount. So so right now, since the market has not gotten to a premium level, which is above this equilibrium, because as soon as this market trades above equilibrium, that is above fair value, the market is already expensive. It's already expensive. Then as soon as it goes deeper, it becomes more expensive. That's why there are sometimes when you see some price action that's like this, okay, let's say a downtrend where the market is dropping, retraced. Let's see another downtrend again, sharp run. Let's see the market retrace. Then see a sharp run again. This is just basic downtrend. This is just a simple price action whereby what market makers are selling from a premium level. So as soon as the market continues going higher, it becomes more expensive. That's why from a premium level in price action, or from a premium level in price action, you see that the market usually drops sharply from that point. From premium levels here, it drops sharply. Then if you should invert this, it's the same thing when the market is pushing to the upside. I hope you get me. So so what we are expecting currently in the short term, we are looking for buy side. Why? Because the reason is because we are expecting the market to retrace. As simple as that. We are expecting the market to retrace in the weekly time frame. So when the market is retracing, it's retracing to to premium, to form a lower high. Why? Because we already have a break in market structure. You can see the confluences. Let me outline them for you. So why are we looking for a buy? One reason would be, excuse me, So one reason is what? We have what? A break in market structure. Let me in higher time frame. That's one. Now that one is anytime we have a break in market structure, sorry, I'm always missing this. Anytime we have a break in market structure, the market is 90% of the time expected to retrace. So anytime we have a break in market structure, the market is 90% of the time expected to retrace. That is 2. And 3, is because the market institutions, let me put it this way. Institutions what are expected to sell from premium. You understand? That is 3. And 4, we have pockets of price action to be filled in form of sell side inefficiency, buy side imbalance. This is this shaded area here. So we have enough conflicts. We have about 4 now. To look for long. So now this, mind you, this is just what? Technical perspective. Technically. I want to so technical perspective. One is we have a break in market structure in high time frame. This is this. 2, anytime we have a break in market structure, the market is 90% of the time expected to retrace. And where is it retracing to? Premium. Why? Because institutions are expected to sell from a premium level. Or okay, let me add the level. Sorry. And 4, we have pocket of price action to be filled in form of sell side inefficiency, sell side imbalance, buy side inefficiency, which is this imbalance here, or you can call it liquidity void. But what you should have in mind is you expect the market to retrace to those levels or price to those levels. So now looking at the market now, we are what? We are bullish. And where is our target? Our target is this shaded area here. For an easy peasy, we just say okay, equilibrium. Why? Because this is what a daily time frame. If you go to, we'll soon go to a lower time frame. So when setting your target, you should try and what, make sure you get what the closest that is closest to your target, where you know price can what easily reach for. Like for instance, now I said the market can what, it can retrace all the way to this high here. Why? Because it's still in our trending range. But that doesn't mean we should buy and what, hold for market to reach for this high. No, you don't trade like that. You don't trade like that, because a lot of things can happen. The market could know, it could drop down, take your stop loss. So the best thing is for you to just target this equilibrium level here. It's a lot of pips. It's a lot. You don't have to trade everything in the market. You don't have to cash every move. You don't have to do that. So let's go to a lower time frame now. We already have our perspective where we're looking to buy the gold market. So excuse me, let me check. This is not charged. Okay. Trying to, like my channel just going bald. So I may have to. Okay, let me just try to wrap this up. So we're expecting the market to be bullish. Okay. So this is now a 4-hour time frame. Like I'll have to end this thing here. I'll be back. You guys please give me some minutes. Let me try to see this. Just give me some minutes. I'll be back. Okay, so I'm recording. I'll just I'll continue from here. Okay. So so like I said, we have a break of structure here. Price taking our higher low. So we're expecting the market to retrace into this premium level, into this sell side imbalance, buy side inefficiency, which is this price action level here. And our reasons are, from a technical perspective, number one, we have a break in market structure in the high time frame, which is this level here. And two, anytime we have a break in market structure, the market is 90% expected to retrace. That is the second reason. Then the third one is, institutions are expected to sell from a premium level. So looking at this market now, we are still in a discount level. So if we expect this market to continue downwards, we expect this market to reprice or retrace towards a premium level. And premium level is above the equilibrium. As soon as the market crosses this equilibrium, price is a premium, then we should be expecting a reversal or a drop down in price at any point in time as soon as price goes above this equilibrium. But we're not looking for sell. What we're looking for is to buy, because before price will get there, it might take 3 days. And we're not swing trading, we're just day trading. That's what we're doing. So let's go to a lower time frame. So looking at this lower time frame now, we look at the market here, you can see that this low here is what gives us the break of structure. After breaking structure, you can see how the market would move sharply to the upside. This is an engulfing candle, bullish engulfing, I think. Yeah, you can see how it moves to the upside. So we have to implement that analysis, that idea that we did in a weekly time frame here. So let's do that now. This we expect price to retrace to this liquidity void here. You can refine it since we're in lower time frame. You can refine it to this level. Yeah. Okay. This level here, so it's where we're seeking. So let's implement that simple market structure reading we did on weekly time frame in the afternoon. So you can see price went to the upside here, then it retraced, forming higher low, then pushes to the upside, forming higher high, then retrace to the downside, forming higher low. Now this is where it becomes tricky. You can see price pushed to the upside here. If you notice here, the market pushed to the upside, then it formed a higher low here, but it's inside this trading range. Let me define the range for you so you get what I'm talking about. Okay, so this range, this high, still inside this range because it has not broken the range. So what you see here, inside this range, what you see here is market formed higher high here, but it's not go above. It's not a larger price range, because if you look at what market has been doing initially, you can see that it formed higher high here, going above this high, then formed higher low, then formed what a short, very short higher high here, then it formed higher low, the upside, higher high, still inside the range, then came down, higher low, still inside the range, came down, goes up, sorry, higher high, go down, higher low. Mind you, these are just easy setups. These are scalping setups. There are some persons now, after forming inside this range now, they will buy here and they will close above this high here, this high, buy and just close above this high here. So let's continue. Price came down here, higher low, then eventually goes above this high, higher high. Now in this kind of price action, what I want you to take note is this: when you see this kind of, if the market is let's say it's, let me use this price action as an example. The market is going bullish now. Okay, let me take it here. Okay, sorry. Okay, so this is higher low, higher high, higher low, then the market starts forming like little segments of price action, instead of the usual, long price range of higher high and higher lows that it usually forms. It starts forming it in a smaller range or in a smaller segment. Start forming like this. I was still in the range. Sorry. I was still in the range. I hope this is recording. Okay. Wow, I wanted to drop something very important right now. Let's just, wow. So, as I was saying, um, so once you see this price link, I don't want to use gamma. Normally, I will just call this price range subordinate to this one. That is the subordinate price range or price action inside this larger or primary or price leg or price range. So once you see the markets, forming a larger price range like this, higher highs, higher low, higher highs, higher low, then all of a sudden or the next price range, you start seeing it become shorter like this. You start seeing it become shorter like this, and it forms higher low. What I want you to have in mind is this price range, this smaller price range, is what we call what accumulation. So market makers are what they are accumulating what orders, that they are bidding orders, that they are what they are offering what in terms of in a bullish buyers now, they are what they are offering what their price, they are offering the market what at a lower price so that they can buy from a discount. So once you see this kind of price action, just know that okay, this market will soon explode to the upside. So expect to see something like this. You see what displacement once you start seeing this kind of price action, which is what we get here. So once you start seeing this higher lows, higher highs inside this subordinate price action, inside this larger trading range, yeah, we just have it in mind that oh, they have started what building orders, they are accumulating their orders. That is what that is smart money or market maker accumulation. So what we are expecting now is we are expecting what a displacement to the upside. So this displacement to the upside move all the way to this level here. And why get to this level? One thing about market is if we go to a lower time frame, we'll see equal highs there. So one thing about price action in the market is that the market tends to reach for these levels very much a lot of time. Equal highs, equal lows. You can see the sell side imbalance, buy side inefficiency here. The market tends to reach for these levels in price action a lot of times. That's what the market do. That's what it does. So continue from where we are. If you look at it, look at this market now. If you look at this market now, why we have this sharp run from a technical perspective. If you look at the price action here, dropping. Let me bring the simple. So this is now is what a lower low. Like I said, once you start seeing this kind of subordinate price action inside a larger trading range, and you start, market start pushing up and down like this, like forming higher highs, higher lows. Once you start seeing this, I want you to have this in mind that this price action here, in this smaller price action here, is what accumulation. So after accumulation, we are expecting what distribution. That is, we are expecting displacement. So that's to tell you that the market will spend little time inside this range. So in this kind of market, like we expect this market to push to the upside, which is what we see here. We saw the displacement here, and market target this equal highs here. Very easy. So if you look at this market now, the reason why the market dropped significantly like this is because this year is a shift to market structure. You understand? It's a shift to market structure because if you look at this market from this level here, you can see here it dropped down, forming a lower low, then it formed what a lower high, failing to take this lower high, then drop down again, lower low, then lower high, then eventually what gives the displacement lower low, then start dropping, see a lower high here, and the market what dropped lower low, then lower high, then lower low, then the market begins. So the last lower high prior to the break of structure is this equal highs here, this level where my arrow is. That's why when this market was reached for this lower high here is what a shift in market structure, because that's the first lower high, the last lower high we got before the break of structure in the higher time frame. So when markets reach for these levels, markets become sensitive in the sense that what, and if you are looking from a technical perspective, we say what the market is overbought. That's why we see this sharp drop here in price action. So if we are looking at it from another point, this is an what internal range liquidity. That's why we are looking at this time frame, this 4 hour now. This is internal range liquidity. There's a strategy here, but I'm not teaching that here. But I just want you guys to have that in mind. This is internal range liquidity. So this significant drop here, just what is the market retracing. And remember, in higher time frame, we're expecting what? We're expecting the market to reach for this sell side imbalance, buy side inefficiency. Why? Because we have our reasons here. We have a break of structure. Anytime we have a break of market structure, the market is 90% of the time expected to retrace to premium. Then 3, institutions are expected to sell from a premium level, because that's what they do. They sell from a premium level and they buy from a discount. So the 4 is we have pockets of price action to be filled in the form of sell side imbalance, buy side inefficiency, which is this level here in the high time frame. And this CB, this sell side imbalance, buy side inefficiency, is inside the premium level. So that is our primary target. So after this significant drop here, if you notice, the market still kept this range. So looking at from this higher low, higher high, higher low, and higher high, we are looking at what from here, looking from here to here as a price range. Sorry, from here, I think, yeah, from here to here as a price range. Let me remove this R and say something. Okay, yeah, from here to here as a price range. So this drop in the market, this sharp drop here, is what is a retracement. So those buyers that bought here, that not join the move here, they will buy at this level here. So if you look at it well, from this new subordinate price range, if you look at the market very well, what I'm about to show you, higher highs, higher low, then higher high. So we are taking the form of this price range, this subordinate price range now. So here is our lowest low. The reason why we are taking the form of this subordinate price range, because this is where they accumulate and this is where we got the displacement from. So this price range now is what is in order. That is in order, guys. In terms of, if we are looking at it technically, you can see that it's in order. So we don't expect the market to break this price range. For those of you that use trend lines, you will draw your trend line like this, if I'm not mistaken. Yeah, you can see it violated it here. But I don't use trend line because all this kind of thing happen. I think a lot of people now, they'll be selling this from here, and hopefully that this is a retest. The market might shock them. So if you look at it, our lowest higher low here is this price leg. So let's take that level. So you can see the market dropped significantly, but it failed to take this higher low, which tells us that, well, we are still in range. Let me delete it. Okay, which tells us that, well, we are still in range. We are still in range. So market drop now. It dropped, retraced to this price range. There is a buy side imbalance, sell side inefficiency here. Let me just outline it for you. You guys will pay attention to all this. Yeah, that's where the markets reach for. So pay attention. So like what we saw here now in this 4 hour, this subordinate price range is what we are seeing here now. You can see after forming higher high, higher low, it start taking what is subordinate price range. That is to tell you that what the market now is what reaccumulation. It's reaccumulating. That's what they are doing now. That's what the market is doing now. So what do you expect now? You expect this market now to what? To push to the upside and reach for what? This level here. But for just to be like easy peasy, we just look at the previous daily high, which is this level. I'm not using advanced terms. I'm just using what? Simple technical analysis, simple approach to technical analysis to get your bias. That's what I'm doing here. So now what is expect now is for the market to what? To reach for this high here. So let's go to a 1 hour. Let's try to define our range. So you can see the market is taking this shape here. So let's drag this. Yeah, so this is our most recent one. Yeah, this high. Want to see the market cross it. Okay, so this is a 1 hour time frame now. So what we are expecting, I zoom out, I just zoomed out. So what we are expecting now, this market now is to retrace. Can see it has six internal range. Let's go to the lower time frame and look at that very well. Can jump to the 15 minutes. Okay. Now we'll use my cross here. Okay, we have equal lows here, so likely the market might still might reach for these levels here. Let me outline it. Remember I said this equal lows, equal highs. Likelihood that the market will reach is very high, and this is great example because the market is very close to it. So the likelihood that this gold market will drop down is very high to this equal lows. So market is not also far from this low here. So likely once you reach for that equal lows, it will just go below this low right here. It's just simple understanding since it's very close. So what we expect now is we expect this market now to reach for this low. Reach for this low. Reach for this low. Then yeah, expect this market to reach for this low. Then once we reach for that low, we'll enter. Then we'll put our stop loss. we'll buy. As soon as we reach for that low, we'll buy. Our stop loss will be this range here. This is where our stop loss will be. Our stop loss will be here. Then we'll expect the market to push, okay, to give us how many. These are our targets. This previous daily high. That's our target. So how many risk to reward would the market give us? 1, 2, 3. Just trying to, perfect, enjoying this. 3. Okay, it's not perfect. Just trying to 3. So 4. Can we get 4? Yes, we can. But just to be on the safer side, I will say risk to reward 1:3. Let me okay, yeah, 1:3. 3 and maybe 3.5. It's not up to 3.5 though. But just on the safer side, 1:3, which is this level here. So that's where we expect the gold market to reach. That's that level. So as long as it goes below this low, we buy. Or if you are, for those of you that are good at lower time frame, you can just look for the shift in market structure in the lower time frame, like in the 5 minutes, 1 minute. You buy, put your stop loss here. Stop loss here. Then risk to reward 1:1, 1:2, 1:3. So if they are risking $100, you are making $300, and that's a very good bang for your buck. Understand? A very good bang for your buck. Easy peasy. Market is fractal. So for those of you that want to hold, then maybe let me go to honor. Then maybe you can decide to hold to 1:4. The market what? Because it's normally we have to expect the market to reach for what? For premium. That's the mode. For market to be efficient, it has to retrace to a premium level. So there's a likelihood that we can get this market reach for this premium level, but at the same time, there's risks in the market. You can see because this price action now it started taking a small range. So maybe you can just get the displacement to the upside straight to the premium, or maybe we can just get the market reach for previous high, then drop down again like it did here. So it's tricky. So the best thing is, if this market gets to this 1:3 level, this 1:3 target here, what you need to do is you take 70% off. 70% of your position, you close it. If you open one lot, you close 0.7 lot, just like that. If you open 2 lot, then you close 1.4 lot. then you leave the remaining lot size, to run all the way to this level here, all the way to this level here, which is in our premium level. You can yeah, so as long as you run all the way to this level here, or once you see that sharp run to this level here, you can close. So that's what I'm expecting. So that's technically, this is what I'm expecting the gold market to do, to reach for this high. And another thing to watch, because there are risks to it. Because we can't just come and say, okay, we want to buy, okay, we just go buy, expect the market to know. There are risks. And what are the risks? Number one is because of the war. And Trump is saying, if there is no deal, if we don't get a deal, then if we don't get a deal with Iran, then it will hit Iran hard, that kind of thing. And also we need to consider the fact that he postponed the time for the time for negotiation from 3 days. I think from 3 days over to a week. I think yeah, he postponed it. So we need to have that in mind as well. So what I want you to have in mind is that if Trump did not make any harsh comment against Iran, that will impact the market, because if he does, oil will, to the upside, which will more pressure on inflation, then the dollar will push up, which will pressure the gold, because the gold is paired with the dollar. You can see it here. XAU is the gold, which is the US dollar. That's what they do. The dollar is paired with most currencies, assets, oils, metals. It's because of the Bretton Woods Accord, that is the agreement for the dollar to be pegged with most currencies and the metals. You understand? Because it's the primary reserve. You understand? So if that puts pressure on the dollar goes to the upside, that will just put pressure on the gold, and we'll start seeing the gold dropping. But if we don't see anything like that, then just expect the gold to just swing to the upside. Very easy. So that's one thing about this trading. There's risks to it. Yes, there's risks. So you should have it in mind that if you buy here and Trump makes harsh comment, you can just see a sharp run, hit your stop loss. It happens. Yeah, it happens. And sometimes you could see a sharp run and just hit your stop loss, then begins to push higher. It happens like that. So everyone experiences, because in this game losses are inevitable. That's one thing you should know. So for a simple approach, this is just what I'm expecting. I myself, I'll take this trade to tomorrow, Tuesday. So I think in the London session, yeah, I'll be awake. This is what I'm taking. So that's all. Very easy setup. I just walked you guys through it. So that's it. Price is fractal. Usually what I mean by price is fractal is that whatever you see on high time frame can also, whatever strategy you use on high time frame can also be implemented on lower time frame. It's the same chart. Like we see here now, you can see the market now taking this subordinate price range here. That's the same thing we're seeing here. So what we're expecting is displacement, just like we saw displacement here. So we're expecting displacement from tomorrow, Tuesday. The concept of the higher lows, higher highs we use on the weekly time frame, that's the same concept that we're using in lower time frame to get our buyers. So there's no magic here. I'm not doing any magic here. So that's just it. So I'm expecting to go tomorrow, Tuesday, to reach for this upside. And if we reach for this upside, this if like let's say Trump say, okay, we are very close to a deal, and the gold market gets to this upside by let me say by London session, I think, towards London close. I mean just towards London session zone close. If the market gets above this high, then we can use this as a breaker, then a bullish breaker, then expect the market to just retrace a bit. Then in the New York session, continue. This retracement just will reach for internal liquidity. because before the market reach for this high, you see what a short-term low form here. That is a higher low form. Then just see the market reach for that higher low, internal liquidity. Then New York session, see the market continue to this high here. But if we don't get anything very positive news from Trump about the escalation, you should just take 70% off as soon as it goes above this high. You take 70%, take it off. Once you get to this one, you should take it off, then you leave the rest to run. Why? Because, and when you leave the rest to run, don't move your stop to like this level or this level. No, don't do that. Just move it a little bit above your entry. That's what you should do. You understand? Because there are sometimes the market will just discount this price leg. Market will just discount it, then just push to the upside again. So if you move your stop loss to break even very deep, you can just take you out and move to the upside. So the best thing is to just push your stop loss a little bit above your entry, in the sense that if price comes down to your stop loss, and it hits you, you just lose a fraction. And besides, you've already paid yourself, so it won't affect you emotionally. Those time on the screen looking at the chart, you won't have to do that. Why? Because you've already paid yourself. You understand? You already paid yourself. So that's just everything. That's everything. If you have a question, you can type your question on the comments, then I will answer it. That's all. That's what I'm expecting. The time is late here, so I'll soon end the live so I can wake up early. Because if I don't sleep well, I won't be able to trade London session. Even right now, it's very late for me. Normally, if I want to trade the London session, I'll sleep at almost 9 o'clock. Yeah. So when I wake up, I will be able to acclimatize with the chart on time. Understand? You can join my Telegram. Join my Telegram, Trade Dictator. I will share this setup here. I will share it on the Telegram channel after I end this live. So that's everything. So since there are no questions, I'll just end it here. So tomorrow, I think tomorrow morning, if I might trade this live, I'll come online and trade it live with you guys. So that's all from Trade Detector. So I hope you guys find this insightful. If you have any question, you can reach me on my DM in TikTok or via Telegram to at Trade Dictator 1. You can reach me there and ask me questions. So hope you guys find this insightful. Until next time, I wish you all good trading.